For many pre-retirees, rental properties have been a cornerstone of their wealth building experience, especially up here in Canada where property values have outpaced wage growth in a meaningful way. The idea of generating passive income from real estate and even passing that down to the next generation is an appealing one. But recently, in talking with landlords, we're seeing more and more realize that being a landlord also comes with its fair share of headaches. Caps on rent increases, longer notice periods, higher capital gains tax rates, increased disclosure requirements. For some, it's starting to feel like a lot, maybe even too much. So as you approach retirement, you naturally ask the question, is it time for me to cash out on my rental portfolio? Is it perhaps possible that the very thing that made money in the past may now be holding me back? So in this video, we'll walk through the pros and the cons. We'll dive into the key factors to consider, from yield and net operating income to the hassle factor and the importance of liquidity. And by the end, you'll have a really clear framework to evaluate if selling your rentals is the best move for your retirement. So this question is a very real one. The last time I was just asked this was just about a week ago by a new client we recently onboarded who owns a small rental property portfolio of about 6 units, or doors as they say, out in a small town in BC. Now, one of the first and foremost factors to consider when deciding whether to sell your rental properties is the current yield and the net operating income from those properties. So let's start with the net operating income. So for example, let's say the property has $30,000 per year of gross rental income, and you carry about $10,000 of operating expenses to maintain that property. So taxes, a property manager, insurance, mortgage payments, maintenance, all those kinds of things. You'd be looking at a net operating income of about $20,000 per year. Now here in Canada, anything bought in the last 5 years with any amount of debt on it, you'd probably be hard-pressed to find that kind of cash flow kicking off the property. More likely, once you add in a 1% annual spend on maintenance, property taxes, the full mortgage costs, strata, if any, you're probably looking at a much lower net operating income. A property with a high NOI, or net operating income, is generally going to be more attractive than one with a low NOI, even if the yields are similar, since a property with a higher NOI will provide more cash flow that can be used for reinvestment, retirement income, or other financial goals that you might have. But let's just first, for the sake of illustration, let's just say it's $20,000 a year of net operating income. The next important figure to calculate is your current yield. So to do that, you're going to take your net operating income and you're going to divide it by the current market value of the property. So not your equity in the property, but just a best guess on its current marketable value. So in this case, if we had $20,000 of net operating income and we had a $500,000 property, we're looking at about a 4% current yield. Now, once you've calculated the yield on each of your rental properties, you're going to want to compare that yield to the expected returns you could get from alternative investments. If your equity wasn't trapped inside that home, what should you expect to get elsewhere? Now, what is an example of an alternative investment? Well, there are plenty, and you could put them probably on a spectrum. Now, on the one hand, today an ultra-conservative option would be a GIC, the term deposit. Today, the rate on a 5-year GIC would be paying about 4.5%, and that would be one comparison. On the other end of the spectrum, you could probably look at the 96-year return history of the S&P 500. Over the long term, the US market has returned about 10% a year annually if we blend the average rates of return of that entire 96-year history. Now, of course, that doesn't happen in a straight line. A given year almost never hits that average 10% figure. But looking at the long-term rolling periods, that's where the market has generally landed. So on the conservative side, you have a 4.5% hurdle rate for safe investments. And on the other side, you've got up to a 10% hurdle rate. So if your investment properties are only yielding 4%, that might not be an attractive enough return, especially when you factor in the hassle, the lack of liquidity that comes with being a landlord. In any other circumstance, why would you accept a lower rate of return on an asset that carries less liquidity, more hassle, less diversification, that kind of thing? Now, that hassle factor is the second critical factor that you need to consider when deciding whether to sell your rental properties. Is the hassle and the ongoing responsibilities actually worth it? Owning and managing rental properties requires a significant time commitment. And if you've done it, you know this. You need to find and vet tenants. You need to handle Maintenance, repairs, you got to deal with tenant issues, complaints, you need to collect rent, manage the finances, comply with the landlord-tenant laws and regulations. This can quickly add up to a full-time job as you scale up the number of doors in your portfolio. Now, while it's often packaged as passive income, the reality tends to reveal that the time and effort required may in fact not align with the lifestyle you had envisioned for your retirement years. Now, obviously, one way to deal with the hands-on work is to hire a professional property management company. They'll handle much of the day-to-day work like tenant screening, maintenance, rent collection, but this comes at a cost. The property managers are going to typically charge between 8 and 12% of the monthly gross rent for this service. And so it's going to eat into your overall net operating income and profitability and that yield that you need to see to make this all make sense. So you'll need to carefully evaluate if the convenience is worth the reduced cash flow. On top of the time commitment, being a landlord can come with headaches that some just don't want to deal with. Problem tenants, property damage, evictions, floods. All of this can feel extremely stressful. Generally, in retirement, you're wanting to minimize these types of aggravations. And so for some, they put a higher priority on reducing these types of headaches from their future lives, as the mental cost of these things just trumps the income that otherwise would be generated from these strategies. By the way, if we haven't ever met, my name is Steve Willems. I'm a wealth advisor with the Willems Wealth Planning Group out here in BC. We started this channel to help you plan for and arrange your investments, your income streams, and ideally have you pay less tax along the way. Now, the third key factor to consider is the issue of liquidity and diversification. Rental properties are relatively illiquid assets compared to liquid financial assets. You can't just sell off a portion of a property, say the laundry room of a townhome. And of course, depending on the market conditions, it can take months to sell a property or otherwise be forced to accept a lower price to facilitate a quick sale, even ignoring the fact that you've got to give even longer notice to any renters right now. So in retirement, if the property isn't kicking off fat stacks of net operating income and the strategy relies more on equity appreciation than cash flow, this can be a challenge. Every situation is going to be different, but you'll want to have other options for quick access to cash to cover medical bills, home repairs, and other financial emergencies. Now, rental properties, to their credit, can also provide some valuable diversification, as real estate tends to have a low correlation with the stock market. Now, this can help you reduce your overall household level risk. Now, that being said, this does cut both ways. Someone with very few liquid financial assets, but a high concentration of localized rental properties in a single geographic area can actually present far more concentration risk than they'd care to admit. The worst case I've seen was a landlord who had doubled down buying up rental property in their pre-retirement years in Fort McMurray, only to be devastated by the combined effects of an oil downturn and then the subsequent forest fires that devastated the town. I just can't shake that story from my mind. So as you get closer to retirement, you may want to shift more towards a liquid and diversified portfolio that includes other assets to just lock in that flexibility and that stability as you get closer to drawing down on your savings. In some cases, when you redeploy that capital, you may even look to recreate and carve out some real estate exposure, but just in a more diversified manner, maybe a REIT fund or some type of private real estate sleeve. The fourth critical factor in this decision comes down to leverage and debt. Now, one of the key benefits, obviously, of investing in real estate is the ability to use leverage to amplify your returns. By taking out a small mortgage to finance the purchase, you can control a much larger asset than you could with just your own capital. And so this can be a powerful wealth building tool as rental income and the property appreciation gets multiplied by the borrowed funds. Now, many real estate investors have built substantial wealth this way. However, leverage is also a double-edged sword. It can magnify your gains, but it can also amplify your losses if things go wrong. If property values decline or even just flatline, if rental income dries up for whatever reason, you're still on the hook. So for those approaching retirement, some wish to reduce this specific risk. So one option is to fast-track the paydown of your mortgages over time with the goal of having the properties fully paid off with minimal debt. Another strategy often used was refinancing the debt down when rates were super low back a few years ago. And this juiced your cash flow. But now as those mortgage terms are coming up for renewal, many are facing a renewal wall with the prospects of worsening cash flow. And this isn't an attractive option anymore. Now, the final factor to consider is just your own personal preferences and perhaps even your long-term legacy goals. Some retirees, they genuinely enjoy the role of being a landlord. They just take pride in maintaining a physical asset, their properties. They actually like the experience of interacting with their tenants. It's fun for them. For these folks, the ongoing responsibilities and the hassles are far outweighed by the satisfaction they derive from this hands-on approach. Now, on the other hand, others have started to view their rental properties as purely an investment vehicle. It's an investment that just happens to, right now, be buried in their real estate. These folks tend to be less enamored with the day-to-day landlord duties. Maybe they've been burned recently by some of the changing rules and the regulations, and they're just preferring, given a choice, the simplicity of a more liquid, diversified retirement portfolio. One important final consideration in this sell versus hold decision is the potential tax impact. If you've owned your properties for many years, you'll likely have built in unrealized capital gains. So selling the properties is going to trigger a tax bill on the disposition, which is going to eat into the proceeds and the amount of money that you would have available to reinvest. This is an important factor, as any sales strategy needs to be dealt with one way or the other. That tax bill is unavoidable. You can only kick that can so far down the road until the taxes are going to come due. So if the benefits of increased liquidity, diversification, and the reduced hassle in your retirement years trumps that one-time tax burden, your path is pretty clear. A qualified accountant or financial advisor can help you model the tax implications and determine the optimal strategy. Ultimately, the decision to sell your rental properties or hold on to them in retirement comes down to the balancing of these personal preferences, your financial priorities, and your long-term legacy goals. There's no one-size-fits-all answer. Each person's situation is going to be a little bit unique. The key is just carefully evaluating all of these different factors that we've discussed: yield, net operating income, liquidity, leverage, and your own desires to determine the best path forward for you. I really hope that framework was helpful as you think through your own situation. I'll see you in the next video.